Still with us is Scott Minerd, Guggenheim Partners Global CIO. So Scott, as I say, we asked for this chart. I didn't know exactly what it would show, and I was surprised at the degree to which corporate leverage has really outstripped GDP growth.
Well, it's amazing. You know, corporations have had every incentive to lever. Interest rates have been low. Their return on equity has been declining. A good way to get your stock up is to borrow money and buy back the shares, and now, you know, we're at the point where it's becoming more and more interesting to do acquisitions, like the CVS deal just a week or so ago.
But one theory would be, okay, you lever up, but you lever up in order to get money, in order to put it to work, and you'll grow the economy faster because the corporations grow the economy faster. That chart would suggest that's not actually what's happening. Oh,
no. I mean, for instance, when you look at the repatriation that we're in the tax cut, over 40% of companies expect to use the proceeds to repurchase stock. It's the fastest way to drive up your return on equity and drive up your stock price. And let's face it, most corporate executives are short-term oriented.
What sectors have leverage that's too high?
Well, look, utility and media to us are some of the most disturbing places. The retail story is played out. I mean, we're seeing the wash out there with Claire's and others. But when you look at the media companies and you see how much leverage they have, you look at utilities, and then a lot of people have kind of forgotten about what went on in the tax reform, which is the limitation on your ability to deduct interest as a percent of EBITDA. So a lot of these companies are now beyond their ability to deduct their interest expense.
So Scott, this is one puzzle for me at least. When you talk to legislators and you talk to CEOs, they say it doesn't matter whether we use the money to buy back shares or pay dividends because it's still going into the economy, and that frees up that capital to be put into other useful purposes. Why isn't that working?
Well, it does work, but it works in the long run. And so, you know, in the short run, there's the short run impact, which is you just lever up the balance sheet. The long run impact is that we do recycle capital, and it raises productivity and output in the economy. But just like the conversation we were having about with corporate investment, there's a big lag here. So, you know, at the end, I think ultimately in 5 years this is good, but in the short run, you know, it's going to create challenges for corporate America.